Alrighty, folks, we have to talk about a report from Goldman Sachs. Yes, Goldman Sachs put out a report yesterday or the day before talking about the S&P 500, aka the stock market, perhaps only annualizing 3% growth over the next decade. Yes, folks, if you've been watching this channel, I've been talking about home appreciation being flat for at least 3 to 5 years, if not the rest of the decade. Now Goldman Sachs is out saying that we could see only a 3% annualized return for the next decade. If you want to know what the last decade annualized return was, it was 13%. So quite a drop there. I do want to say good morning to all of you coming in. I'm liking this StreamYard thing. It allows me to do some pretty cool stuff. So hopefully the quality and all of that is the same as before. If not, let me know in the comments. I'll go back to doing Zoom or whatnot. So at the end of the day, again, we need to think about the next decade. We created a lot of asset inflation in the first couple of years of the 2020s. And it only comes to be that regression to the mean probably means that the rest of the decade is going to be flat. You can't simply, randomly pick stocks and everything will go up. You can't do that with real estate. So what I think this means is we got to keep doing the work. We got to go find value. We got to find, we got to find and or create, our own opportunities. So again, this is what I see coming, right? I've been talking about this no landing scenario. No landing again means higher rates. It means we have a lot of pain, but stretched out over perhaps years, much like the early 80s. If you haven't looked at the 54-year spreadsheet, go to my website, onerentalatatime.com, take a look. It was not a fun couple of years. But again, even in that painful environment, there's always opportunity. You're going to find some pretty motivated sellers. We got a comment the other day talking about, hey, if this happens, Zuber, is this going to lead to opportunity in the 5 to 40 unit buildings, right? The small multifamilies. And absolutely right. That's this no landing scenario, higher rates, meaning lower cap rates, lower NOI, values getting crushed. There's going to be some opportunities, whether they be outright foreclosures, whether they be motivated sellers. It's coming, but it's not going to come in a wave. That's what I want people to understand is this is not going to be Wile E. Coyote going over a cliff and then falling all at once. It's going to be, a slow trajectory of pain. And again, I think the pain stretches not only because of higher rates, but it's just, we got to pay for the crazy debt structure that we have. There's a lot of opportunities that were financed with debt, a lot of companies, a lot of real estate. And, at some point you can't hold forever. You're going to see some pain. So now we have Goldman Sachs talking about stocks or equities, basically having a lost decade. Because if that's a 3% annualized and you have 2% inflation, that's a nominal 1% growth. So again, going to be really, really interesting to look at. I do want to talk about that wonderful, awesome Pace Morby interview yesterday. I don't know if you saw it. I took a lot of notes myself. Hopefully you did. But I wanted to talk about two things specifically from the Pace Morby interview that I'm going to look to implement. That they were that important, and I think you should at least think about them. Right at about, I think, the 30-minute mark or so, Pace shared a story from his friend Brent McDaniels about creating a board of directors. Right? You've heard me talk about firing your friends. You've heard the quote, "Show me your friends, I'll show you your future. You are the average of your 5 friends." We've all heard this. I think this concept of creating a board of directors is pretty powerful. And I really like the idea that Brent even took it to the next step where he interviews his board of directors, his friends, once a year. And they just put it all out there. right? In this case, Pace shared in the story where he had to go over revenue numbers and company numbers and all of that. I don't know. I think it's pretty powerful. I think having a board of directors, right? Thinking about it as board of directors, it's that important. It's that important. And just saying you've got 5 friends or 5 buddies or whatnot is not enough. I think by calling it a board of directors, it gives you the gravitas. It gives you the importance. It gives you, it gives, at least to me, it gives me something. So I thought that was pretty powerful. And then if you stayed to the very end, at the very end, Pace shared a wonderful story about Ken McElroy. Ken McElroy is one of Pace's mentors, and I think he's very lucky to have Ken in his corner. But if you didn't hear that story, I'll try to do it justice. But again, this is on video, so you can go back and watch it. Obviously, Ken McElroy has built an amazing business, a couple of $1 billion in real estate, if not more. And unfortunately, one of his regrets was that he got divorced. Right? He basically built a business, ignored his wife, and that didn't end well. So Pace is at a dinner, I guess, and talking to Ken. Laura, Pace's wife, who is wonderful, was very pregnant, and Pace had a conversation with Ken, basically, sharing the story of his struggles in his first relationship, and the topic comes up that Pace's wife Laura is pregnant. Oh, when's she due? Tomorrow. And Ken basically said, "Get out of here, go home, be with your wife. Get your priorities right." So that whole family, the importance of family, is awesome. Again, the fact that Ken has his business wired where he's basically in the office 90 minutes a week is pretty awesome. I think there's a lot that we can learn from Ken McElroy. Obviously, he puts out a lot of great content, but hearing that story, and at least for me, raised Ken's profile, in my opinion, because it's not all about climbing the mountain. It's not all about this or that. It's about family, the importance of family. So if you haven't seen that, go to the end. I think it's probably the last 20 minutes or so of that 2-hour conversation. There's a lot more things that I took from the conversation. Let me know in the comments below what you took away from it. I'd love to hear. I think I have 5 or 6 notes that I wrapped up with. So again, I thought that was pretty cool. Let's congratulate somebody for doing the work. This individual, somebody I used to work with, he actually goes down as one of the earliest subscribers. Kevin, I think he was subscriber 9 or 10. I mean, way back in the day. And I just want to congratulate Kevin and Shelly. Kevin and Shelly, this is your golden ticket. Where is it? There it is. This is your golden ticket. Congratulations for doing the work. Thank you for all the support. We've been friends for decades, and I just want to congratulate you for getting your deal, and your card will be going out in the mail. So pretty cool to see friends take action and do the work. Let's talk about some earnings. We got some powerful earnings. I think I read somewhere where about 20% of the S&P 500, so roughly 100 or exactly 100 companies will be reporting this week. I got a few of note. We will get SAP and Zions Bancorp today. For me, it's all about Zions. Again, I'm looking at the second tier of financial institutions. All the big boys beat top line, beat bottom line, reserve for bad debt. You know the story. It was kind of rinse and repeat. I'm not sure that's going to be the story for the next tier. I think what we're going to see in the next tier is some balance sheets in tatters and maybe some that are actually getting stronger. I think we're going to see a lot of separation at that next tier, and no idea who's going to win or lose, but that will be interesting to look at. Tomorrow we get General Motors, Verizon, and Sherwin-Williams. For me, it's going to be about Sherwin-Williams tomorrow, right? What is going on with remodels? What is going on with home construction? What is going on with, painting the kid's bedroom or whatnot? Is that contracting as well? Have we already done all of our painting projects and we just have this gap? Was there a pull forward? Then Wednesday we'll get Tesla, IBM, Coca-Cola, and AT&T. For me, probably, yeah. I think it'll be Tesla. I mean, obviously Tesla's one of the big boys, very passionate investor base. It'll be interesting to see what's going on with Tesla. Thursday, that's a big one. UPS, American Airlines. What's going on with shipping? UPS has been a harbinger of the economy for a long time. So I'll be looking to see what's going on with shipping. And then we have New York Community Bank Corp on Friday, again, looking for that second tier to see what's going on. We have seen the jump in the 10-year note. 10-year note jumped over 4.1 today. So again, I think it was 4.11 the last time I checked. Again, Fed cuts, but rates go up. This is normal. Somebody asked me the other day if this is normal, and we actually talked about it. I think there was a chart we put out. I don't know. I think Matt, the mortgage guy, had it the first time. A chart we put out that showed the aftermath of the first rate cut. 10-year actually did go up. I think all but one, like 9 out of 10 times it went up. It doesn't usually stay up, obviously, because the Fed is cutting for a reason, i.e. a recession. But we'll see this time. This time it certainly feels like we are not in a recession. It certainly feels like a no landing is becoming more and more possible. So this time may be different, and we're going to have to pay attention to that. Real estate news, active inventory is up. Active inventory jumped 1% week on week, now up 33.4% year on year. Again, more inventory, buyer strikes. It is a buyer's market. We got that one right. Again, as investors, we don't care about cost of capital because we only write great offers, right? We only write great offers. So again, if rates go up, it just means our offers are lower. And the seller could take it, the seller can negotiate, or frankly, the seller could take it off the market. Again, don't do that. Don't write disrespectful offers on first day listings. But hey, let's look at 30 days. Let's look at 45 days on market. There are plenty of opportunities out there. I do want to highlight some people that joined school in the last 24 hours. I want to congratulate Sergey and Marissa. Sergey and Marissa, thank you for joining. Remember, level 2 unlocks 6-hour masterclass on creative financing. Shout out TYLG or Ty for putting that together. And level 3 gets you a $1,000 10-week boot camp that you can watch on replay. So again, when you join school, interact, introduce yourself, talk about your buy box, your experience, comment on other people's posts, and you will unlock some amazing values at level 2 and level 3. And to be clear, getting to level 2 and level 3, you could do in 24 hours if you spent a little bit of time in the application. So again, Sergey and Marissa. And don't forget, folks, in about 17 minutes, I will personally go live in school for an hour where I will just take any and all questions and see what's what. So look forward to seeing you inside school. Go to the calendar. There is a link, and we'll talk shortly. So that is happening. Next up, let's talk about wealth. I don't know if you saw this, but the Federal Reserve put out a report talking about the average wealth between 2019 and 2024, kind of before and after this crazy money printing. Guess what happened? Well, remember, inflation's a feature, not a bug. Remember, a rising tide rises all boats. But I don't think most people would imagine what would have happened. Most people would likely say the wealthy got richer. Okay. But what about everybody else? Well, again, the Federal Reserve put out this report. You can go Google it. The bottom 50% of wealth, right? The people that had wealth in 2019 versus 2024, wealth jumped almost 100%. It went up 95.9%. So again, a rising tide certainly helped the bottom 50%. Now, obviously, it helped asset owners versus asset renters. We've talked about this forever. Again, if you want to get wealthy, you've got to own assets. It is sometimes it is so simple. But yes, the bottom 50%, nearly a double in 5 years. The next tier they looked at is the 50 to 90%. That tier went up 53.6%. The top, they call it the top 9%. So from 90 to 99%, that went up 37.8%. The top 1% went up 42.2%. And then the tippity top, the 0.1, the ultra wealthy, went up 71.3%. So again, the bottom 50% with nearly a double. If you're lucky enough to be in the top 0.1%, you ain't doing too shabby at 71%. So I thought that was an interesting review of the last 5 years. And again, asset owners win, asset renters not so much. Want to talk about the accountability group that just happened on Sunday. Shout out Jared and team, had 12 people on. That's awesome. Talked about cap rates, Chamber of Commerce, other things as well. Again, find the time that works for you. Monday morning's accountability group just finished. It started at 6 a.m. So shout out to all the early birds out there with Max and team. Again, you also have one on Wednesday. So keep it up. Figure out what is right for you. What else do we got? Oh, let's talk about leading economic indicators. This was the first economic report of the week. It just came out this morning. Again, leading economic indicators, kind of a call for the future. What is coming down the pipeline for the economy? And no bueno, not good. The previous mark for leading economic indicators was negative 0.3. The expectation is that it would be the same, negative 0.3. Actual came in at negative 0.5. So yes, folks, as we called, I think Q4 could be a weak quarter as buyers retreat. The good news is the election is almost over. It's only, I think it's 15 days from today. So again, it will be behind us before we know it. And hopefully we can just start, the consumer will stop retreating is the hope. So again, we'll see where that is at. Anything else? Oh, last thing, looks like pendings are up actually 10.2% more single family homes in contract when you look year on year. That was another housing stat I didn't highlight earlier. And you got to remember, sometimes we forget these things. Last year this time, we were talking mortgage rates at 8%. That's important because it really just gives us an easy compare, right? Today's rates, I think last time I checked, are 6.6. So certainly much better than 8%. I think it peaked at 8.03. So again, rates are lower than last year, but again, they're up from the cycle bottom of 6.11. So again, folks, I hope you have an amazing day. Don't forget to join school. It is only 67 cents a day. Again, you're part of a community, almost 300 members. I think we're 3 away from 300. I think we're at 297 amazing individuals networking together, helping each other, asking questions, commenting. It is going to be one of the greatest places to be if you are serious about investing in real estate. Crazy price point, tons of value. Join, have some fun. And I'll see you in a few minutes. We're going to go live in about 10 minutes. So I hope to see you there. Take care, everyone. Bye.